Good morning and welcome to this Monday, August 22nd, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, last week was Max Pain week. We talked about the possible downside and the directional clues that gives us. And sure enough, after 2 months pretty much of unabated moves to the upside, it was time for the market to come down, and it came down. The worst day of the calendar month historically has been the Monday following options expiration Friday. And I'm talking about monthly options expiration. That occurs the third Friday of every month. So this past Friday, August 19th, was our third Friday. This morning, I don't know if you looked at futures, but it looks like we're probably going to get off to a little bit of a rough start. Futures currently are showing the Dow down 335 points, 1%. S&P 500 futures down 50. That's down 1.18%. And NASDAQ futures are now down 200, which is down 1.5%. This is on top of the losses last week. And I'll go over and talk about this in a little bit, but the thing that just really stands out to me is the manipulation that takes place the week of options expiration. The QQQ, and again, I'll show you this in just a couple minutes, but the QQQ was down about $10 as of Friday's close from, I think it was Tuesday's close or maybe Monday's close. I'm not sure. Anyway, $7 of that $10 drop was the net drops at the opening bell last week. And now here we are set to drop on the NASDAQ another 1.5% at the opening bell. Just about the entire drop has been an opening bell. I wrote about this last week in the daily market report. I think it was in our Friday report to members. But 70% of last week's loss was at the opening bell. There was no real distribution. There wasn't a lot of selling taking place. There was a lot of back and forth. We did finally see some selling on Friday, but I honestly think it's these gap downs that encourage the selling. You know, when you're losing money, you're losing money. You're not sitting there saying, well, I'm losing money, but I'm not losing it intraday. It's only at the gap. I don't think too many people think like that. Most people are thinking, I'm losing money. And so you start thinking, oh, wow, this rally's over. And then you begin to sell. So it's almost like market makers begin this chain and then others jump in. And then when everybody else starts selling, we got to be watching in the afternoons coming up this week, because if we're starting to see buying again in the afternoons, this is just rinse and repeat. This is, market maker thievery 6.0 or 142.0. We'll see what happens throughout the end of this week. But to me, already what I've seen seems to me to be a lot of manipulation. I mean, if the QQQ, if we go down at the open another $4.50, which would be roughly 1.5%, maybe it's a little bit more than that, maybe close to $5. But if we go down another $5 at the open, we will have dropped $15 on the QQQ, and 12 of it would have been at the opening bell. $3 of real selling out of 15 during the day. Nobody talks about that on CNBC. Nobody's going to talk about that. But anyway, I find it pretty important. But let's, for those of you that are new, let me go ahead and get you situated here. First, I just want to point out that if you are new, thanks for tuning in. We certainly appreciate you. We appreciate all of the folks over at, that have been supporting us at Earnings Beats for these many years. But if you go to our homepage, if you are new to Earnings Beats, go to our homepage, you scroll down, we have a free newsletter. I would just encourage you to sign up. It's no credit card required. It's just name and email address. Hit that subscribe button. There's 3 newsletter articles published each week, Monday, Wednesday, Friday. The one I did this morning was on Etsy. If you recall, members who were at our Max Pain event last Tuesday, we went through and we shared a lot of stocks that could potentially drop this week or last week because of Max Pain. But I did one manual calculation that I kind of went over with everyone. And it was one stock that I had shorted because there was so much in the money call premium, and it was Etsy. And so I featured this morning in the EB Digest Etsy and where it was at the time we talked about it last Tuesday. I think it closed over $120. Max Pain was down around 101, $20 below. And I mean, normally you think, okay, $20. We're in this nice bull market rally. Who in the heck thinks that Etsy could drop $20 heading into option expiration week, right? Well, it got down to 107. It dropped $13 between Tuesday and Friday. And of course, with futures down this morning, I see Etsy's down almost $4 at the opening bell. Right now at pre-markets, it's 103. Max Pain, 101. Price was at 120 Tuesday's close. If you don't follow Max Pain and you don't understand the market maker role, you shouldn't be trading around this time of the month. I mean, it's as simple as that. Now, does Max Pain work like this every month? Of course not. Nothing works all the time. But this is one more directional clue, one more, I'll call indicator thing. You need to be aware of it. Let me just say that. Because anybody who has been watching Etsy thinking, well, it's pulled back from 120 to 117. Let me jump in. Obviously, they had no clue about Max Pain and the fact that 101 was where market makers needed price to drop in order to basically have a windfall. I think I calculated $23 million of net in the money call premium on Etsy as of Tuesday's close. I can promise you, as of this morning, pretty much that 23 million has been wiped out. That's just one stock. Talked about the QQQ and the Spider, the SPY last week. And the fact we could see anywhere from, I think it was 6 or 7% drop. Well, the QQQ was down from 332 to 322. That's 3%. Throw on another 1.5% this morning. And for those of you who think, well, yeah, but this is the next week. Why would that have anything to do with options expiring last Friday? Well, anybody who had options that were going to expire last Friday, and if you were in the money, you can exercise. If you exercise, market makers are then on the short side with the stock. There's no difference. So the early part of the week following option expiration matters, which is why the Monday that follows option expiration is always such, well, let me just say it's a day that you need to be aware of. And it's the reason why, in my opinion, it's the worst trading day of the calendar month. Every month, it's the Monday after options expire. I think that day has been down 63% of the times since 1950. So holding on a Friday night, if you're a trader, long positions going into Monday morning, the day after options expire, 63% chance market's going to be down that day. Now, I can tell you that normally any other day since 1950, the odds of going down any other particular day, 47%. 53% of the time, market goes higher. But 63% of the time, it goes lower Monday following options expiration. It's just odds. It's not a guarantee. But if I'm a trader, I want to know all the information. I want to know what these market makers are up to. Anyway, I just wanted to point out that in the EB Digest today, that was, again, we try to make it as educational as we can. So make sure you sign up. The other way, if you haven't already signed up for our event on Saturday, August 27th, you're going to want to be at this event, especially if we continue to see these gap downs and we get some afternoon buying later this week and the market's down and everybody's going to be screaming, here we go. This is the next leg of the bear market. And I'm going to be sitting back saying, yeah, right. I mean, let's see what happens throughout the balance of the week. But I'm going to talk on Saturday about where I think the market's going. And it should be a really, really eye-opening event. Very similar to what I do for Market Vision at the beginning of the year. We do our annual event where I give my forecast for the year. This will be a little bit of a mini forecast through the balance of the year and perhaps into the early part of 2023. But definitely sign. You've got to, in order to get your seat, you've got to be registered. So sign up. All it is, it's free. There it is, FREE. It's free, but you've got to be registered. All right, let's move on. What happened on Friday? Shocking. I say that tongue in cheek. Lots of sarcasm. Dow Jones down 292 points, S&P down 55, NASDAQ down 260. By the way, those NASDAQ stocks got a lot more in the money call premium than you typically see on the S&P and on the Dow. So am I shocked that the NASDAQ more than doubled losses over the Dow? No. That's where a lot of that options money was sitting, right in the NASDAQ 100. Anyway, down 2%, mid caps down 1.6, small caps down 1.8. Moving on to the sectors, we had healthcare rising. Well, healthcare hasn't really gone very much, hasn't done much. Not going to have a whole lot of in the money call premium if you haven't been going anywhere. Look at the weak areas, discretionary, straight up. Financials have had a big run going into options expiration. Materials, maybe not as quite as much as some of the others, but still a big run. And then technology, of course, technology, a lot of big option money in the technology sector. So I look at all this and I'm like, what do you expect? We talk about this every month. Opposite George week. Whatever was working heading into the week doesn't work. Anything that wasn't working into the week does okay. And that's exactly how it played out again this week or last week. And I would be looking for that into the first couple of days, 2-3 days of this week. I think Max Payne options expiration Friday tends to carry over right into the first 2 or 3 days of the week, or the week following options expiration. So anyway, just more market maker manipulation, more fun. 10-year Treasury yield. Give you an update here. Right now, we're at almost 3%. Had a big move up on Friday. Don't know if you noticed that. So this is starting to look much, much more like sideways consolidation than a continuing downtrend. Now, I do think we're going to eventually trend lower, but this doesn't look like a downtrend any longer with a lot of this action above the 20-day. So I think we're just going to see a lot of back and forth. We might get up to this maybe 310 area. Now that we're up, got through 290 or so, I would be looking maybe 310. To the downside, I think this 260, 255 area could still come into play and still be in this more sideways consolidation. I think for those of you who are more bearish and are thinking rates are going to go shooting higher because of inflation and the Fed being hawkish, if you break through 310, I think you got that chance to go back up to 348 again. And I'll be honest, I'm going to try to be objective through all this, even though I called a bottom. Hey, if we go back through 348, that is clearly something that, in my opinion, is in the bears camp. You got a check mark in that column, the bears column. If you can get this yield back up through 348, I'm going to have problems putting a positive spin on that. The only way you can put a positive spin on higher interest rates is if it's the strength of the economy that's causing it. If it's inflation fears, that's a problem. So, yeah, I'm watching the TNX. That's going to be one of the things I'm sure we'll talk about on Saturday. All right, S&P 500. So here was the pullback last week. Again, not really much of a pullback. Today, we're going to be down. Well, let's see. The spider right now, pre-market, is down 1.16%. So that's going to pull this down, I don't know, probably close to 50 at the open. That takes us down to 41.78. The 20 days at 41.62. That's just a normal 20-day test. Now, there hasn't been a whole lot of selling. I mean, when you go back over here, you can see a lot of big red-filled candles. Here, most when we've had any selling, it's been mostly gaps. I don't see a whole lot of big red filled candles in here. Friday was one of the biggest. Of course, options expiration day after a gap down. I mean, I think we're going to see a gap, and I think we'll see intraday selling, at least in the morning. That's been our history. But if we go down below that 20-day and we come back up late in the day and hold it, that could be the end of the selling. To me, that's the first key support area. And I'm not just saying this because we've been down for 4 days. I talked about this beginning of last week. I said it was not safe to be in long if you're a trader. Now, if you're long-term, I would just ride it out. I would have ridden out the whole first 6 months of the year. Cyclical bear markets, as a long-term buy and holder, they don't last very long. You go right back to all-time highs afterwards. If you're, you don't really try to time the market. I think secular bear markets that don't break to new highs for 12 years are a different story. I don't think that's what we have on our hands here. And feel free to disagree. That's what makes up a market. Everybody has their own opinions. Buy, sell, bear, bull, whatever. What I can tell you is that usually when you come out of cyclical bear markets, which are short-term bear markets, they tend to last 3 to 6 months. This one was 5.5. Normally, the moves out hold the rising 20-day moving average until we see a negative divergence set up on a daily chart. That is the historical norm. So today's gap down, anybody who got out at the beginning of the week on the long side, honestly, I think the 20-day is a good opportunity to at least begin to build your position back up again. I think the top of this gap down to the bottom of this gap, right in here, is what I would consider to be a good accumulation area if you're looking to get back into the long that you sold last week. Lots of stocks are down from where they were a week ago. Like I said, Etsy, 103 in pre-market was 120 on Tuesday at Tuesday's close. There are lots of others like that I'll show you in a few minutes. But I want to just go over this S&P. I want to go through and talk about some numbers. Hopefully your eyes won't roll back in your head here as I go through this. I'll annotate this and type it just for maybe effect. Since 1950, here are the S&P 500 returns by period of the calendar month. If we look at the 26th of the calendar month to the 6th of the calendar month, all calendar months, the 26th to the 6th, so that's that same period, 12 months a year, times 72 years, the annualized return for this period is 21.41%. I call it money flow. It's the money flow period. That's when money comes in. First of all, you get the anticipation from the 26th to the 31st. All the financial managers, money managers, the hedge fund managers, market makers for their own account, they're buying heading into the end of the month. Why? I audited, when I was in public accounting, I audited firms, and most firms had 401ks that I audited, and most had payrolls that ended at the end of the month. Either they had monthly payrolls that were once a month, for like on the first of the month, or they had twice a month payrolls that were the 15th and the 30th, or 15th, 31st, or first 15th, first 16th, something like that. Most of the companies I audited. The companies, as fiduciaries, they collect everyone's 401k money, and they turn around, they send it to Fidelity or Vanguard or whoever is sponsoring their plan. And those folks take that money and it's wired to them. So they're getting their money very quickly. Now, Fidelity and Vanguard doesn't sit there and look at sustainability ratios and divergences and all those things and decide whether or not they should invest for people in their 401k. When that 401k money goes there, there's a directive. Fidelity and Vanguard immediately buy whatever it is that the individual employees have designated. They don't hold cash and try to make timing decisions. They get the money on the first, they invest it. So starting on the first through the first 3-5 trading days of the month, money flows are coming in. That drives prices higher. So you got the front runners. I like to call them the front runners, legalized front runners, market makers, portfolio managers, hedge fund, all these guys getting in, gals, all these folks getting in the end of the month. And then the money flow comes in. There's your 21.41%. Annual return on the S&P is 9%. So if all these periods were equal, we should see annualized returns of 9% for each period, or roughly. The fact that it's 21%, if you're a trader on the long side, this is the best time to trade. 26th toward the end of the month. Do what the professionals are doing. Next period, 7th to the 10th. This period since 1950 has produced annualized returns of minus 5%. That's 14 percentage points below that 9% level. I just consider it a profit-taking period. Market makers, hedge funds, managers, I think they get their run up and they take some profits. And we move into the 11th to the 18th period. For me, I call this the rinse and repeat period, which basically it's like the 26th to the 6th, just to a lesser degree. Plus 12.64%. Remember, those payrolls, 1st and 15th, many of them have payrolls middle of the month. Now, some of you are saying, well, my company, they pay weekly. Some companies do. And you know what? Some of those weekly payrolls will be at the end of the month and the middle of the month. My point is, that's when most of the payroll money is coming in, first in the middle. First of the month, middle of the month. You'll have some other plans that send money in different periods. But to me, the 11th to the 18th is rinse and repeat. Money coming in around the 15th. There's your professionals getting in ahead of time from the 11th to the 15th. There's the money flow, actual money coming in that drives the market higher. And then we get to the 19th to the 26th. And this is what I consider to be legal thievery period. I think this is when you're going to see most of the options take effect. Now, keep in mind that options expire the 3rd Friday of every month. That means that has to occur between the 15th and the 21st of a calendar month. When's the Monday following options expiration going to be then? If the Friday has to be 15th to the 21st, the Monday that follows has to be the 18th to the 24th. 18th to the 24th, pretty close to that 19th to the 26th. The annualized return here is minus 7.79%. Blow this up. Take a good long look at this, because these are numbers that have been, this has been going on for 72 years. You would think over 72 years with all this data that all 4 of these would be somewhere near 9%. But that's not how the stock market works. This is short-term inefficiencies, money flows, max pain, options, market makers. These are the big Wall Street firms. You think they're not trying to make a little extra buck here and there? We know they'll do anything to make money. There's trillions of dollars in our market system, trillions. You have to understand this information. So, I mean, if you want to just ignore it, that's fine. But as a trader, I got this ingrained in my head. I know when these dates are every month. Now, does that mean that 26th of the 6th is going to go up every month? I can promise you the answer to that is no. I mean the 7th to the 10th always going down, 19th to the 26th always going down? No. The answer is no. There are no guarantees in the stock market. We talk odds, we talk probabilities. I can tell you what, if I get to the 19th of the month, and I know this right here, and we're going into options expiration, and we've been going straight up like we have for the last 2 or 3 weeks, and I know there's a ton of in-the-money call premium sitting there on the table for market makers. And then let's say negative divergences start printing on 60-minute charts. And then we notice that money starts rotating more to healthcare and utilities. And you put all this stuff together and it's a puzzle. And I start to get really confident that the market is not going to go any higher in the near term. And I put my stops in play, but I'm going to get more aggressive, either selling my long positions or potentially even going into short positions. It's all based on history and then where you are in the market every month. Again, I'm not going to say I'm going to short on the 6th of every month at the close, and then I'm going to go long on the 10th, and then I'm going to short again on the 18th, and I'm going to go long on the 26th. Over time, yeah, that would work. But again, you're dealing with pure 2020 hindsight. Is that going to work next month? And the month after that, the month after that? What if you go through 3 or 4 months where things aren't working out? You start off with 100 grand, you're down to 80 grand after 4 months because this isn't working. What are you going to do? You're going to be like, the system doesn't work. Even though it's worked for 72 years, you're going to make the assumption it doesn't work because it hasn't worked for 3 months. But this is one piece of the puzzle that I always keep in mind. And now as we're dropping, Friday, by the way, the 19th of the calendar month is the worst calendar day of the month. If we look at the 1st versus the 2nd versus the 3rd, all the way through the 31st, the 19th historically is the worst day in the all calendar months. Friday was the 19th. The other way of looking at it is the worst day of the month is the Monday that follows. And of course, that's going to be, it could be the 19th some months. It could be the 18th some months. Remember, options expire anywhere from the 21st, or excuse me, the 15th to the 21st. So the Monday after is going to be anywhere from the 18th to the 24th. If you take all of those Mondays, that from the 18th to the 24th, that is the worst day. That's worse than all the 19ths added together. And so today is that day. So Friday was the 19th. Today is the Monday following option expiration. Are you surprised that we had a big down day on Friday and now we're seeing big bright red futures on Monday? Because I'm not. I've seen this so many times. It's crazy. Now you might look back and say, well, look at end of March. That went the other way. Well, guess what? Heading into option expiration, where were we? Heading straight down. We had a lot of net in the money put premium. So it benefited market makers that month for prices to rise, and they did. Anyway, pretty interesting stuff. It's 9:30. I want to show you a spreadsheet, though. We've been doing Max Pain now for our members for quite a while. All right. I can't get the... Well, I don't know if I'm going to be able to get this for you. Oh, there we go. I don't know why it wouldn't let me minimize the screen. All right. So I just want to show you a spreadsheet that we did for our members. We sent it out last weekend. And we did this list of individual stocks. So Erin Weber, who's our vice president of operations, she puts together this spreadsheet and essentially just sends it to our members. Or last month, I think, was the first time we sent it out ahead of time on the weekend before options expire. But essentially showing all of our members, all of our portfolio stocks, the S&P, or no, all of our portfolio stocks, the Dow Jones component stocks, 30 of them, and then the NASDAQ 100 stocks. So there are 100 of them. And there were some duplicates, so I got rid of those. But essentially what this spreadsheet is all of those stocks in our portfolios, the NASDAQ 100 and the Dow 30. This was the calculation of the net call or put premium. We've got it listed here in order. So Tesla had the most in the money call premium last week. Stock on Tuesday, when we did Max Payne webinar, closed at 900. Or no, actually, yeah, that was Tuesday. So it closed at 900. Now we calculated Max Payne at 813. And I know Tesla went down maybe to 870 or something. I don't have my charts up right now. But we closed at 890. So the point here is we didn't go down $87, but was it a good directional clue? 900, it went down $10. How about Amazon? 143. Max Payne was 123. We went to 138. Apple was pretty stubborn, but it did go down slightly. Netflix, 249. Max Payne, 202. Went down, closed at 241. PayPal, down $5. Microsoft, down $5. NVIDIA, down $9. Google, down $4. And so on. These top, where all the money was at stake, almost, well, probably every one of these, all the way down to Cisco, all of these went down last week. And Max Payne would have suggested they were going to go lower. And you might say, well, yeah, but the overall market went down. Well, the QQQ and the Spider were anticipated to go lower. So, yeah, I mean, we're looking for the market to go down last week. Now, the other thing that this can help is even if you don't short, because I'm not a huge fan of shorting when I believe we're in a secular bull market, and I believe we're resuming that right now. So I don't really like to short. Max Payne week, if there is a time when I'll short, it's going to be that, because I know market makers likely have a financial interest in bringing prices down. So if I'm going to short, that's going to be the week I tend to do it. But otherwise, the market tends to go higher. And I'm not going to try and fight. You know, I just think that's an uphill battle. But every one of these, all the way down to Cisco here on this line, every one of these were projected to move lower, and they did. Not 92% of them, not 96% of them, or 78% of them, 100% of them. It's a pretty strong percentage. I mean, look at end phase. 299, Max Payne 228. I mean, it's down $16. It's a big drop. That was one of the largest projected drops. If you look at where we closed versus Max Payne, projected a potential 23% drop. But any dollar that goes down toward that Max Payne level is a dollar that is saved in terms of paying out for Max Payne options expiration. And this is how much money is at stake for each individual stock. I think Max Payne for the Spider and the QQQ is $3.3 billion. Anyway, stuff's pretty important, I think. All right, that's essentially what I wanted to go over today. Why don't we look at, maybe I'll pull up a couple stocks for the three you must see that were on that Max Payne list. Just look to see, okay, Tesla, all right, down another $21. So now all of a sudden, that 813, we're getting closer and closer. I actually like Tesla on the 20-day. And if you wanted to go back down, I think the 840, 850 area provides pretty good support. But I wouldn't have much problem entering short term a couple of different places, starting here and moving down to 840. If I'm right, the market goes up, many of these stocks hold their 20 days. They're going to likely bounce off of these areas. That was Tesla. Let's look at that end phase. Look at end phase down another 570. Again, 20-day test, gap support. I'm going to say upper 260s to around 277, kind of be an accumulation area for me. The stock was just 310, breaking to all-time highs. Just a normal pullback. And then let's see, what was the other one that we had on the list? Well, let's take a look at Etsy. Let's see what Etsy's doing today. Well, that'll be our third one. So Etsy right now, 104, got to a low of 102.52. Max Pain was 101, and it was 120 right here on Tuesday's close. 4 days heading into Max Pain, $23 million worth of net in the money call premium. Poof. Gone. Just like that. And if we come right back up and finish, we could have potentially some kind of reversing candle. Could be piercing, could be a bullish engulfing candle. If that turns out, if we end up going back to an all-time high, folks will just say, well, that was just a 20-day test. We went just a little bit below the 20 and right back up. Won't think anything of it. Won't get mentioned on CNBC that Etsy had $23 million of net in the money call premium that many individual investors probably just had stolen right from them. That won't get mentioned. It'll just be a 20-day test and back up again. Maybe we go down to this gap support area. 20-day tests don't always hold. But I would be looking for a reversal pretty quickly, pretty soon in Etsy. And then if we do get back up past that 120 level, start hitting 123, 125, new highs, just look back at this. Honestly, in a normal society, there'd be somebody behind bars. But this is the way legally our system works. So as a trader, you have to understand Max Pain. You have to understand it, and you have to at least consider it. It's not always about shorting. Let's just say you wanted to buy Etsy at 120. If you know Max Pain is at 101, do you really want to buy at 120 on Tuesday? Or 117 on Wednesday? Or 113 on Thursday? Or 107 on Friday? I would wait. 104, things are starting to look a little bit better for me now from the long side. Anyway, that's all I got for that. Let's see what the market's doing. Dow down 403, big shocker. S&P down 59, NASDAQ down 209. Huge move lower. Got the VIX. I think the VIX is probably going to top out around 25 or 26 tops. I'm not sure we get there, but if we do, going to have a lot of bears screaming, this is it. Here we go, rolling over. And I'm going to just say, well, you're going to have to show me a lot more than this. This is Max Pain. Anyhow, that's where we are right now. I'm going to go ahead and wrap this up. Appreciate everybody tuning in. For those of you that are members of Earnings Beats, I was traveling this weekend, so I didn't get that weekly portfolio report out, but I'm going to work on that this morning and try to get that out for everybody. And I also will start with some of those setups. With this pullback, this is going to set up potentially pretty nice for some longs, in my opinion, going forward. But anyway, all of that will be out later today. And then should be able to get back on schedule. So everybody have a great day. Be back tomorrow over at Stock Charts TV for the next episode of Trading Places Live. That'll be at 9 a.m. tomorrow. So just go over and click on Stock Charts TV right at 9 o'clock. You should be able to listen in. Everybody have a great day. Happy trading.